Yes.
Good morning, Atlanta, and especially Southwest Atlanta. I'm Dr. Mary Parker, founder of the Mary Parker Foundation. We are so excited to be with you again this Tuesday, the last Tuesday of April, which is our actual meeting date. Every last Tuesday of the month, we present various topics here at the Mary Parker Foundation Community Conversation Session. And today, we are so happy to bring back for you up on demand, Miss Regina Page. Miss Regina Page was also here with us back in March, and it was so much information that those of you who were watching, so many of you request that we bring her back. So she's here with us today, and we're going to give her the entire session. So please feel free to chat, to include whatever questions you may have in the chat box, and we'll be sure to answer your questions. But for now, I want to introduce to those of you who may be new and didn't get a full scope of who Miss Regina Page is. This is Regina Page, and she is the owner, the CPA, and the president and CEO of Tax and Accounting Services. We're bringing Regina back for you, primarily because of all the conversation last time. We generated so much interest in the financial requirements and how do you prepare for buying a home. Regina's going to answer a lot of those questions for you today. I'm not going to belabor talking about her anymore. I'm going to allow her to do that herself. Good morning, Regina.
Good morning, Mary. Thank you so much for having me back again.
And thank you so much for answering the clarion call, because our phones and emails, everything was jumping off the hook with people wanting to hear more from you.
That's
so thanks
awesome.
again for being here. And you know, we absolutely appreciate all that you do for the Mary Parker Foundation.
Absolutely.
Yes. So Regina, just go ahead, tell them a little bit more about you. And if you would, just tell them about your company, how you can service them, and then we'll go into specifics about your reason for being back today.
Okay, thank you so much. As Mary stated, my name is Regina Page. I own a full service CPA firm. I've been in practice for 25 years. I started out as Tax and Accounting Solutions Incorporated, and now I am Regina D. Page CPA and Associates, because I understood a little later that it is very important to brand yourself, because the services that we offer are personalized. So as I stated, it's a full service CPA firm, which means we do everything that our big three firms do, which includes tax preparation for individuals as well as business owners, consulting for people who want to start their own business, write-up services such as bookkeeping, where we produce your financials, we give you your metrics to measure how well your business is doing, and we also do audits for the City of Atlanta's Department of Aviation. So that's the services that we offer.
And those are great services, Regina, services that can be used both by small business owners as well as personal. So let's dive right in today. One of the questions I have for you is, how can someone know when they are financially ready to purchase a home?
Okay, one of the things that you want to make sure to be financially ready to purchase your home, you need to have at least 6 to maybe 12 months of savings that are for emergencies, right? So also you'll be required to pay about 20% down, and also your debt to income ratio needs to be 35% or less. So if you have all those things in place, you have a good relationship with a real estate agent or a mortgage broker. So you need a team of people to help you through the home buying process, starting with me, your CPA. If you're a self-employed business owner, you want to be careful not to run losses, because most times business owners will continue to run losses just to not be able to pay taxes. But that puts you in a situation where if you're looking to purchase a home or get a business loan, you won't qualify if you're constantly running losses if you're a business owner. So that's one way you need to prepare, to have at least 3 years in a row of profits from your business, right? If you are an employee and you don't own your own business, you're a W-2 employee, you need to make sure that you have enough money saved and that you look at your budget in terms of what you can afford. Before you go looking for the home, first pre-qualify to make sure that you're not looking at something over and above your budget and you'll be disappointed or you'll overextend yourself.
That was an excellent answer. And I would like to really encourage any of you who are first-time home buyers, or even if you want to buy a second home, to get with an accountant CPA first, because one of the things I've noticed in talking with members of the community, we're finding that when you get to the point of going to the real estate agencies first, they're going to find whatever means necessary to get you in your home. Hence is why visiting with an accountant to understand where you are financially is going to be the key. So I'm encouraging your first step to home buying is to speak with a CPA or an accountant, and they will advise you accordingly. Hence, when you're meeting with the real estate agencies and or some of the services they're offering you, you'll already have the mindset of buying. You'll already have pre-qualifying questions because you've already spoken with your accountant. And that is wonderful. Regina, how often do you see residents or community members who go for home buy, let me start over. How often do you see people wanting to purchase a home, know they are not in a financial situation, and the agencies will still get them in there? What is your thought in cases like
you
that?
have to be very careful because sometimes real estate agents or mortgage brokers are motivated just to sell you the home, and very sad to say, just to get that commission. So you definitely want to talk to someone like me, independent of that home buying process, to make sure that you're ready. And also, when you're not ready, sometimes you pay an interest rate over and above the market rate for if you had everything in place, like your credit score, your debt to income ratio. So typically anyone can buy a home if they have the money, but you have to be careful in terms of the interest rate you'll be charged because of your credit and the risk of you not being able to make good to service the debt.
You know, that was a very, very good point. And we're really going to dive in on that credit score. We talked briefly about it last time. If you were advising a client in terms of their credit score, what number would you suggest they're at? And just the score, and we'll then come back and add some other components to that.
So your score probably needs to be anywhere from maybe 675 to 700, depending on the circumstances. So again, if your credit score is low, you may be required to put more down.
Okay, so in looking at a credit score of 675 to 700, there's a 75% difference there. How would a 25-point difference in a credit score impact the interest rate?
It will probably take it down a couple of points. And speaking of your credit score, one of the things that you want to do in terms to bring that score up, most people say, okay, I have all this debt, I'm going to go just put a big chunk on it. Your credit score goes up more if you systematically say you have $5,000 in outstanding debt that you want to pay, as opposed to just paying that $5,000. You should pay maybe $1,000 for the next, 5 months, and your credit score will go up higher because it's showing you're systematically paying consistently on time. So you'll get a bigger boost in your score.
You know, that is really amazing. And I know that, but I have a habit because I use my credit for different reasons. But I have not gotten to the point where I needed to pay the bills consistently. And that's what they're looking for, is your payment history. When you pay your bills off or your credit cards off with one lump sum, you either make money or your credit score may remain the same or go up just incrementally 2 or 3 points. So Regina, I want to ask you about budgets. When people come to you with the intentions or the aspiration of buying a new home, how often do you see that people really understand the importance of budgeting?
I think the budget is an afterthought. They know what they want. They know the type of home that they want. So they look at that first and then try to back into it. But you really need to look at your budget and your financial situation first. Specifically, now that you're a homeowner, there are going to be other expenses that come with home ownership. You have to consider taxes and insurance. And the biggest thing, depending on the timing when you purchase your home, you're prepaying some of the taxes within the mortgage. So the first year in owning a home, you may get a huge check back from the mortgage company. And I would advise anyone not to spend that, because that's really the difference in the escrow from the taxes that was covered during your closing. So you either want to deposit that in your account and save it, because next year, when that tax bill is added to your mortgage, it's going to go up, or your mortgage may go up. So be cognizant of that, to just hold on to that check and deposit it, because they're going to want, you to be able to pay your taxes with that, or your monthly mortgage amount may increase.
That is great. So will you share with us some of those commonly overlooked expenses?
Okay, so commonly overlooked expenses, when you're in a home now, if you're coming from a home to an apartment, you're going to have more utility use, you're going to have more water use. Some of the things that may be covered from a utility standpoint in an apartment is not covered in a home. You have to think about more utility costs, the maintenance and the upkeep of your yard. And then also, if you're living in a community, sometimes there are homeowner association fees that you have to pay monthly. And over time, those homeowner association fees may go up. So you have to consider those are the things outside of your mortgage. Also, your homeowner's insurance as well is usually included in your mortgage with your taxes and insurance. So those are additional expenses that you may need to be aware of, or emergency repairs or maintenance. Typically, the home ownership warranty comes with a 5 to 10 year warranty for certain things. Certain things are 5-year warranties, certain things are 10-year warranties. And then after that time ends, you can purchase a home warranty on your own, and it's really not that expensive. So I really highly recommend purchasing a home warranty after that builder's warranty has expired, because you're going to find that you need that when it comes up to repairing things like your HVAC or other things around your home that need to be repaired.
Yeah, I'm so glad you mentioned the home warranty piece. That is absolutely something that you want to research. They're all different. Some of them you have to enter longer term contracts than others. Others will cover certain appliances, and there are those that only cover items inside your home, your appliances, the big things. But the one thing that your home warranty does not cover are some of your personal items. So you want to make sure when you're seeking a new provider that you ask all the questions that you can possibly ask to ensure that you don't have surprises. I want to share this really quickly because it was something that just didn't make sense to me, and that is your garage doors.
Yes.
That was the biggest surprise for me. My garage door broke. It was insured on my homeowner's warranty. But how, when I'm making a decision, or while people are making decisions about these types of programs or plans, how am I supposed to know that it only covers the chain and the hardware? Sure, it's somewhere in the small print, but do we need to have attorneys and CPAs evaluate these kinds of plans for us as well?
Absolutely. I think that's a good idea, because we see so many, we know where to go right to the fine print where that particular clause is written. So we have an eye for that. And I want to add one more thing as it relates to homeowners insurance. If you have jewelry, wedding rings, things of value, you want to make sure you include that in your policy as well. You're not just covering the home or the dwelling, you're covering the contents of their home. If you have valuable family heirlooms, if you have china, things of that nature, jewelry, you want to make sure you list that on the policy and take pictures of that and keep it in your file in a safe.
Because it only insurance only covers certain points.
Right.
And that goes back to this insurance more inside.
Read your policy. You want to request when you get your policy, these are the things that I need to have covered, right? So typically they will list what's covered, and then if you need to add any additional items, they would price that out for you. So it's everything, yes.
And the other thing that you may want to include in that is a rider policy for your jewelry and other expenses, because they have a cap on what's insured with those type of personal items with most of your insurance policies. So that is something, your furs and your jewelry, specifically your art. I happen to be a collector, and
I've seen your art. My goodness.
I would list, my policy covers a certain amount, but when you're a collector, and some people can just get one piece and you need to add an additional rider on that. So please, whenever you acquire assets, always research to determine what is it going to cost for you to keep that. Because once you make a purchase, that initial down payment is critical to your expenses. For example, there have been many people, and they're still doing it, get in homes, and there are all these other expenses that are surprising to them, and they're in the house less than a year. But they ended up moving into a $600,000 home that required 20% down payment. That down payment is gone forever. And when you lose your home, you don't get anything back but bad credit. So be very, very intentional about your knowledge before going to talk to a real estate agent or anyone else about purchasing a home. And when you do decide, two things will happen. You're more informed in selecting the agent to represent you, and you're absolutely more informed about the budget that is going to be required for you to get in the home and to stay in the home. Regina, I don't want us to stay here just talking about home buying, because I find that when it comes to utilizing CPAs and accountant, which is one of the most critical professions that one needs to have in their toolkit, so that you can pick up that phone and call whenever. In addition to purchasing homes, let's talk about some of the other reasons that businesses should be intentional about having a CPA on their team.
Okay. We are tax strategists, right? So each client that we serve, we treat as an individual. Although some may be in the same profession or segment, each individual client is different. Some people are business owners. They've been in business for 10 years. Some are new, some 5 years, some have a family of 4, some have a family of none. So what you want to keep in mind, you need a CPA for where you, not just where you are right now, but where are you trying to go? We always ask our clients what their goals are when it comes to owning your own business. If you're currently employed, are you working a full-time job and starting your business? When do you plan to leave, or do you plan to leave your business? Look at the benefits that your business offers. If you have health insurance and dental with your employer, now that you're going to be self-employed, how will you still be able to maintain and get health insurance or dental insurance? In terms of being with your company, if you have a company 401k plan, we sit down and look at what types of investment vehicles they offer you as an employee. How much do you need to set aside in your 401k? Because that's the single best tax strategy, because your 401k is pre-tax. So whatever you put in your 401k is deducted from what your taxable income will be, notwithstanding everything on your itemized deductions, that will be a deduction for you. So I always recommend for my clients to, if you have a company 401k plan that you can participate in, please max it out if you're able to do that from a budget standpoint. Participating in your 401k and if you, or 401k plan if you're employed, or having a retirement account if you're self-employed, that is a must. That's a budget, just like paying for space to rent your office or to lease a space, right? That is a monthly bill. Your investment in yourself and your future and your retirement is also, I consider, an ordinary and necessary business expense, and it will save you from a tax standpoint.
That was an excellent, excellent feedback. Now I want to dig into 401k.
Okay.
Because I personally know several people who didn't really understand the implications of withdrawing from their 401k before the retirement and before the allotted age to avoid the penalty. Please.
Yes, I'm here.
On that as you can.
The current age is 59 and a half, right? But there are some exceptions. If you were separated from your employer, you may not have to pay the penalty, but we recommend that you borrow from your 401k to make the down payment on your home versus taking a distribution. Because if you withdraw and take the money out, not only are you going to pay taxes on that, but you're also going to pay a 10% early withdrawal penalty. So it's better to go ahead and borrow from the 401k versus taking a distribution. And if you leave that employer before you pay it back, then it becomes taxable again. So you have some options there, but I highly recommend doing a borrow against the 401k versus the distribution.
Earlier, we spoke about employers having 401k plans. You encourage that whatever percentage to max the match.
Yes. First, you look at, from a budget standpoint, you want to contribute at least the amount that they match, right? But a lot of people stop there. I recommend still contributing more to that 401k outside of the match, because that's your investing and saving in yourself. And I like to share this example. Had a client for the past 20 years. I remember when his son Nick was 14 and playing baseball. He graduated college and everything. All his friends wanted to get their own place, get their apartment. His dad encouraged him to stay at home. I'm saying, Nick, stay at home. When you get your first job, I want you to max out the 401k. He's only been working for maybe 3 years. And each year, when I looked at his W-2, he maxed out his 401k. This young man has over $100,000 saved in his 401k. While all of his friends decided to leave the nest, when parents said, you could just stay here, they just wanted to be on their own. So he's way ahead of the game. So you want to, when you practice good financial habits, that rolls down, to your children. So I highly recommend even investing above and beyond the match. Also, there are other retirement accounts such as a Roth. It grows tax deferred. After 5 years, the earnings on that Roth is tax-free. You pay no taxes. But the difference with the Roth, those are after tax dollars, so it's not a tax deduction on your return, but it does allow you tax-free earnings after the 5-year period.
This information is invaluable, you all. And I said to Regina the other day, I'm finally thinking as a retiree, and I'm going to plan to retire. And I encourage all of you to do the same. But planning to retire begins now. It begins when you're younger and you have access to additional funding before all of those expenses, family, tuition, paying all that back, include your retirement and all of this, and know that it's there. Regina, I want to ask some questions because oftentimes I have people asking this. What is a major difference from a tax perspective in purchasing whole life insurance and comparing that to a 401k plan?
I think you can do both, right? So with the whole life, that's still after tax dollars, but you can borrow against that policy. So instead of borrowing against your 401k, you can borrow against the policy. And again, it becomes taxable if you don't pay it back. So I think you should have a hybrid of things. Like we talked about the Roth, we talked about the 401k, we talked about the whole life policy. You can borrow against that, and that helps generate wealth, and it makes you look good on paper when you go to purchase your home or other things to start a business. You may want to get a line of credit. Those things help because there are assets that increase your net worth that makes you a good credit risk.
That's beautiful. That was one smart thing that I did. Let me share something with you from an age perspective in terms of acquiring insurance. In many cases, when we learn things, we're already beyond the age where we can maximize the benefits from it, right? This whole life insurance is one of them. One of the things I did for my family was as the next generation was as they were having babies, I insured the babies. So you can insure $1 million baby for 10 years, and the rates are substantially lower than to insure myself at $1 million at 55 years of age. That difference is incredible. So the deal that I made with my family is that whole life policy, once that's paid in full, it becomes an asset.
It does.
To each of the children. Now, tell me if I've done anything wrong here. I don't think so. So what I do now is actually I will borrow.
Yes.
I will use the dividends within those accounts to borrow from instead of borrowing from the bank. I borrow from myself and then I pay it back. The other part is that I'm also using the dividends as a retired part of my retirement plan. Each of the young people, my $1 million babies are generating dividends annually. When I have a need for that money, that's my money until each of them reach the age of graduation. Then that is my gift for them. All the dividends that are acquired after age 18 belongs to them. But I'm able to use that money that was invested for 18 years for each of them at a very, very low rate. The other thing about whole life insurance, and I'm not necessarily advocating for them, but I will call one of the agencies today and they can sponsor the next show. But the other thing about the whole life insurance that I really, really like is you can decide whether or not you want to pay off what you borrowed back to the policy or pay the interest. You can pay the interest with the dividends that you're making annually, which the dividends will not exceed the interest amount that you want. Well, it could, but just be real conscious of that. But more importantly, when you use these type of techniques for advancing your own financial status, just make sure that you know the rules, that you play by the rules. Because if you don't pay the loan back, and if you don't pay the interest, guess what? It's being deducted from the face value. So my baby, my $1 million baby, at age 50, if we do not pay it back, guess what? There could possibly not be a policy. And these are things that are not always clear or explained in that manner when we're dealing with the insurance agency. So anything that we do, we should be doing research and asking questions, and even asking the client, no, it wouldn't be the client, the provider in that instance, of some of their clients that you may be able to talk to that have discovered things that were not mentioned to you. So just be involved and be aggressive and be intentional about the health of your finances.
And I wanted to elaborate a little bit on what you said about the whole life. Another part of that is a critical care rider. So say, for example, that policy has a $500,000 face value or surrender value upon your death. If you become critically ill, some policies, depending on which type you get, will pay up to $4,000 a month for your critical care, which means you can have someone, that's enough at least now, for someone to come in your home and take care of you, where you don't have to go into a nursing home where you really don't know how they are going to care for you or your loved ones. I have so many situations where clients had to pull their parents out of nursing homes because they weren't providing adequate care. But if you're able to age happily in your own home with this policy, sometimes it pays up to $4,500 a month for that care, but then upon your death, it still is going to pay out on the policy. So that's definitely something I would look at in terms of getting that with the whole life.
So with that, and I have that, but here's what I don't recall, is whether or not, if I do use the critical care, will that be deducted from the face value of the policy, or is
I
that
think it's pro rata, depending on how much you use. And I'm not a licensed insurance agent, I'm a CPA. I know just enough to be dangerous, but I have partnerships with people who sell these products. So it doesn't have a major impact on that payout or that cash surrender value, because that's what the premium is designed in case you do need that, but it's not going to drop it by $100,000 or something like that.
Very good, very good. So for those of you who do not have critical care on your plans, make sure that it's also part of your retirement plan, and especially if you want to live home like myself. And so you want to pre-plan now, so those services will be available for you at age 100. Well, I mean, that's because that's the age that I know that I'll still be functioning. We have to have a plan, right?
Yeah, we're living longer, so you need that.
That's right, that's my plan. So anything after 100, well, you guys can decide how you want to disperse that. Regina, red flags. I mean, there are just some things we should just have common sense enough to know. And I know this sense is not common, but there, when we're looking at the expenses and benefits and all of that, there has to be some red flags that might alert a lender before they get so far in the process that this is not a good candidate. Can you speak to some of those red flags?
Yes. To me, the biggest red flag is this. Someone who's not my client, they're trying to buy a home, they file tax returns with losses for the past 2 or 3 years, and they want me to amend the tax return to show more income so that they can meet or qualify for the house. That's always a hard no for me. always a hard no for me. So what I do for my business clients that may not yet be homeowners, we kind of talk about, oh, well, I don't want to pay taxes. How can I generate a loss? That's not smart. You're not in a home yet. We have to, first of all, exercise integrity and report what's right. It's not tax avoidance. It's more of a tax strategy to legally minimize or reduce your taxes. That's what I do. There's so many different strategies that you can use to minimize your taxes. And one of the biggest things is home ownership, because you're able to itemize on your Schedule A and write off things that you may not be able to write off if you did not own a home. So that the biggest red flag for me is someone wanting to come in and wanting me to amend their return, or they want to report a certain amount of income, right? But they really don't have the documentation or the bank statements to prove it. And then after the fact, they may want to come back, okay, I'm in my house now, can you amend my return? That would be a no. That's a big red flag.
Now, do you understand why it's so important for us to have certain professionals on our team? We cost ourselves so much money by not going to people like Regina for some of those financial decisions, both personally as well as in our businesses. We do what we do. They do what they do. We just need to identify the ones to bring onto our team to make life better for us, and that we can keep more of our money in our pocket. And I don't know why that is. What are some of the reasons that you hear that we may be able to listen for as well? What are some of the reasons you hear that people just don't manage their finances or don't use budgets?
I think it happens most with my business owners. Instead of them paying themselves on W-2, they just want to take distributions, right? Just take the money out of the bank and use it at their will. A lot of commingling, mixing personal with business, not having a separate business account. So that's one of the things that I see a lot of, and not good record keeping. So if you're ever audited by the IRS, I have never lost an audit. In fact, my clients probably get more money back because sometimes I'm conservative depending on the type of business. So that's one of the things that we.
And never talk to an IRS representative without speaking with your accountant first.
Yes, because they tell lies. They do. And I don't know why they tell lies, right? We're in a different date and time. I had a client who did quite a bit of marketing, right? Where it included fashion, clothes, hair, Instagram, all those things. And she can't wear those clothes again. And well, why is she writing off these clothes? I can show you videos. Go to this page. This is everything she's doing. That's a legitimate business expense, right? So in terms of, if you get a call from an IRS agent, you do not have to talk with them. If they show up at your office, give them my card, say, yes, you need to reach out. This person will sign a power of attorney, and you don't even have to deal with them. You don't have to show up to the meetings at all. I just handle that for my clients because they tell stories and they lie because it's their job to generate as much revenue for the IRS as they can, but it does not happen on my watch. I can guarantee you that.
Let's give a round of applause for that. That's totally right. We love integrity because, you know, it's so easy if you don't know, and if the people you're dealing with don't have the integrity and they're looking to line their pockets, you're in trouble. You were going to say something, then I have a story.
This the biggest thing. They sent one of my clients who had her own retirement account because she was self-employed. And somehow Morgan Stanley did not close out the account properly. She received a $258,000 tax bill. They kept saying, pay it, pay it, pay it. I had completed all the paperwork aside from Morgan Stanley from a tax standpoint. They kept saying, I was like, this bill is not right. Try to contact taxpayer advocate, went down to the IRS. They said, don't have an appointment. We're going to get you escorted out if you don't leave. I said, okay. So I partnered with another tax attorney. I said, this is not right. I'm not an actuary. The actuary didn't close us out, but this is not my client's tax bill. It took us 6 months because the first person I talked to did not document the system properly. She closed everything out. She wanted to be lazy. So working with the attorneys, finally got the letter after a year and a half, zero balance. So I go to fight for my clients. Can you imagine keep receiving notice if you owe $258,000, right? And I'm talking about someone that's in their 70s, $258,000, gone, zero.
They actually took the money from her.
They didn't take it. They kept sending her a bill saying you owe this, or we're going to levy your property or put a lien on your bank account. I know that she didn't know this. I had to go through so many hoops.
Well, I'm not advising any of you to do what I do. But here's what I've learned. When I get bills like that, I will look at them and say, Lord, you got more money than me. Let them know that
For
they
your
have more
works.
money than me too. We'll get to it. And then I'm gonna call you. But don't be anxious. Don't let that unravel you to doing things that, in addition to the letter, you're now gonna have to recover from as well. So just always remember, for legal concerns, you call your attorney. For accounting concerns, you call your accountant or CPA. For spiritual concerns, you call.
Get on your knees.
You call
Call
on
the name of
Jesus.
Jesus.
You notice how I had to think about that, right?
Yes, yes.
Yes, but the first call is to the Lord.
That's right.
Then you might want to call your pastor and talk about it. But go
There's
ahead.
something else in terms of someone being self-employed. Real estate agents and brokers, right? Real estate agents are 1099s, right? The broker, the real estate broker has an office full of agents, right? They're 1099s, right? A real estate broker had about 30 agents. When she applied for her tax ID number, she said, I have 30 employees. Employee, contractor, big difference. So if you're an employee, the employer is required to file the 941s where they're withholding and remitting your taxes, right? You're sharing the employee share. Her folks are all on 1099. This lady literally came to my office and said, I'm gonna lose everything. I got this huge bill from the IRS. It was over $100,000 because, you know, I have, you know, they're saying I have to pay taxes on my employees. I said, you're a real estate broker? Yes. Do you pay your agents 1099s? Yes, I do. Okay, I can make this go away in like 5 minutes. Give me just a sec. Picked up the phone, called the number on the letter. These are 1099 contractors. You should see 1099s in the system under this particular company. Phone call, wiped it out. There. Oh, thank you very much. We'll check the box that she won't get any more notices. So please do not lose any sleep at night crying over a letter from the IRS. It's one small technicality. 1099 contractor versus an employee. You can own a brokerage firm or any other, and you may say, these are my employees. So when it comes to taxes, language and understanding means everything. This lady, and she said, well, how much do I owe you? Nothing, because I'm a praying woman too, so I'll get it back on the other end.
Amen to that.
A 10-minute phone call, that's all it took.
She's operating out of her hip.
I'm just picked that. I might stay here.
As business people, and especially professionals, we must demonstrate those characteristics. That's first and foremost. God can't use us without
He
that.
can't.
No. Anything else you want? Well, we'll come back to you. Any questions from our audience, or do we have any questions in our chat? No chat questions. Any questions live? Everybody in here are homeowners? You too, hey, let's go to first-time homebuyers then. What are some of the things? I have a question here about first-time homebuyers. What should first-time buyers consider? Should first-time buyers consider using retirement funds for a down payment? What are the pros and cons? Let me explain that. The reason I'm asking this question is because I have two granddaughters currently living together, and they are each wanting to buy a home. I want to finance their home, but what caution, if any, that you would advise me about using my retirement funds to make that purchase for them?
Well, that depends. If you decide to borrow against it and pay it back, that's a good idea. That's an option.
Leave it to me, right?
No. I'm thinking. I don't want to get too deep and get into trust and putting it in a trust. You know, buy it and put
I
it.
don't want to do it
Okay,
that
you
way.
want it for them to own it. Yeah. So you can borrow against your retirement for the down payment.
Yes, I want to borrow. I want to buy the house for them.
Outright.
Undisclosed.
Okay.
And I want them to pay me with a year for a year with the option to then put it in their names. That's to help them and make sure that I'm helping to manage
Okay, I
this
think
new
that,
ordeal for them.
yeah, that's a good idea because that teaches them responsibility and that gives you the opportunity to see if they will be responsible homeowners
Absolutely.
and how they work together to pay the mortgage or pay you what you're requiring. I think that's an excellent idea.
Absolutely. And that's something also that within our community, I just want to expound on just a little bit. You know, I have lots of friends, my age, so I'm a little bit older. And the one thing that we don't necessarily consider is helping our children while we still can financially,
Right.
so that once they receive our hard-earned dollars, you know, that money that's called inheritance,
Yes,
we will know that they then know how to manage that.
right.
Do you see cases like that as an accountant? And will you talk about some cases that you've had to bail people out of because these were not things considered when they sold grandma's house or when, you know, they inherited so much from grandma? Yes, I am using trust, but we still want some practicality
Yes.
as well.
And this is a tax strategy that results in a big tax saving. So say, for example, your home is worth $4 million, right? And upon your death, the children inherit your home. There's something called basis. So the children take on that home at the fair market value on the date of death, right? So it's worth $4 million. Say you sell it for $4 million, there's no capital gains tax. Now, I don't know what's going to happen with the Job Act and tax cuts at the end of this year when this expires, but that's what's in place right now, right? So there's zero capital gains on that because they take on the same basis, the fair market value at the date of your death. If it were different and they didn't take on that basis and they take on the cost, your cost basis, what you paid for a while ago, then they're going to pay capital gains on that difference. And that's huge from a tax standpoint.
Is that the same principle if the home is paid off?
Yes. The
So
same.
I buy my home for $56,000 30 years ago.
Mm-hmm.
And today's fair market value of that home is $4 million.
Yes.
Their
basis in that property is $4 million.
If they do not sell the home, there is no capital gain.
And even if they do sell it, there is no capital
If they
gain.
sell the $56,000 purchased home for $4 million,
Their
their-
basis is your fair market value at the date of your death.
So they realize the benefit of that gain. without
Yes,
tax, without
that's right.
paying tax.
That's right. That's right. And then two, let me talk about sale of your primary residence. You get a one-time exclusion. So say, for example, you bought your home for $100,000. You sold it for $300,000. You're a personal primary resident. There is no capital gains tax because you get up to single a $250,000 exclusion on the gain of the sale of your primary residence. Married filing joint, you get a $500,000 exclusion on the sale of a primary resident for your personal home.
married filing joint, you get.
$500,000. Single, $250,000.
So,
You can exclude that gain on your personal home reselling.
so we have to have fun, right? So single people who owns $1 million home can get married for tax benefits too.
Absolutely. Absolutely.
I love that.
Mhm. Mhm.
And get divorced after the taxes are. Remember, we're talking about financial benefits here.
Right, right. That's a strategy. That's tax
Let's talk
strategy.
about this one offline. Okay, there's a question in chat. Is that answer or following up with this question that's on the table?
No, it's actually, they wanted you to expand on, putting your primary home in a trust.
Versus sale or versus inheriting.
Mhm, mhm. Now, I'm not a trust attorney. Again, I know enough to be dangerous, but in terms of putting your home in a trust, we are, the individuals that I partner with, you want it to be a revocable trust, meaning you can make changes to it. So that's a way to protect your assets from any lawsuits if you own business or things that come up. If it's in a trust, it's protected. Say you go out and you're driving, you hit someone and they sue you, they cannot sue you for your assets, your home, your lake property, your private jet, all those things should be in the trust. And the beneficiary of that trust is typically your children, your spouse first. So that's just a way to protect your assets. So if you're just buying a personal home, and this is the queen here, right? She knows why I've recommended the trust for her, because we don't know what this property for those granddaughters are going to look like, because she thinks and dreams big. So that's why I recommend the trust for that. So that's definitely to protect your assets from any lawsuits that that may arise for you personally. So if you don't have anything and someone sues you, they can only get so much because everything is protected in a trust. And when I was coming up, I didn't know about these things. I only learned about it because I just happened to be the beneficiary on one of my relatives' policies. So they went through all the paperwork with me, and then continuing to study and master my craft by spending money on continuing education, go to conferences, speak to people who have been doing this for years. One of my mentors is part of one of the oldest Black established CPA firms there is in the US. So you always want to connect with people who are doing what you're doing, who've been doing it for a long time.
Now, I heard her talk, she mentioned cars, she mentioned homes in trust. But I hope you all heard one thing that's generating this question. She said, when you put your things in a trust, specifically business owners, and for those wealthy people who don't own businesses, if someone sues you, you hit someone, and all of your assets are not in a trust. What happens if the cars are in a trust?
They're protected as well. Oh, you mean in terms of if the car that you're driving, that's a good question.
Is in the trust, and the car, someone is in an accident and the car that is owned by the trust. Can
they
the
sue
trust
the
then be
trust?
sued?
I'm not an attorney and I try not to practice law. That is a good question. I wish I had my phone. I could use a lifeline.
Okay, I'm gonna take privilege to answer
Okay,
this one,
okay.
because I did ask that question. to the
Okay,
attorney.
good.
Absolutely not.
Right.
Do not include your cars that
Yeah.
people are going to drive in your trust.
Mhm.
If you got antiques or something like that, that is a,
Right.
that another asset that's not gonna be used, or it's not going to increase risk, you can put that car in. But if anyone's driving those cars, you do not want those to be in your
Right.
trust, because the liability only shift from you
Right.
to your
Yeah.
assets that are
Right.
now in the
Yeah, I don't
trust.
think I've seen any vehicles in any of the trust documents.
Well, I was gonna put mine
Really?
in the
If
trust.
you were getting wise counsel.
Yeah, and that's when it happened, because when he said that, I thought, well, what if my cars are in the trust?
Mhm.
Those are the same assets that I'm trying to have protected.
Right.
So, yeah, and that was the advice, don't put the drivable cars in there. We have 10 minutes left. Have you all enjoyed this session? Is this one of those sessions that you think would be worth a workshop? Absolutely, we believe so as well. So we're also promoting Regina's business, and I'm so proud of her. And a lot of the people that you'll see come through are people that I've developed relationships with over the years, because I know that what she does is important to me, but more importantly, we want to always be raising up the other generation. I'm so proud because when someone asked a question at the airport about if I knew an accounting firm to do audits. That was what, 10 years ago?
Oh, longer than that.
Yeah, it's
Longer
been a
than
long time, but I said, yes, I do. So when you're coming to events like this, make sure that as you're networking, that we all know what it is that you do when you leave here, because our intention is to connect the opportunities that we're presenting with the people who can provide those services or other professional resources that we're bringing here for you. We have, again, we have live guests as well as online. We're so excited here at the Mary Parker Foundation with all the things that are going. And Regina, you absolutely make an excellent partner for us.
Thank you so much.
And so we will continue to bring you on. Anything, if you have any, workshops or anything you're doing, please forward your information to us. And
Okay,
we will be intentional about sending it
Okay.
out, and we'll add a note to it indicating
Okay.
that you've been
Okay.
here and that you were brought back by popular demand.
and I do have something coming up. Biblical entrepreneurship is one of the things that I will be launching very soon. So look for information on that. Because we all believe and trust in God. I am only here because He allowed me to live out my purpose and my dream. He showed it to me when I was 17 years old. So everything I did was strategic to get me to this point. And as Mary mentioned earlier, us becoming friends and just being in contact with her and being in the right place at the right time. When you go to Hartsfield-Jackson International Airport, when you walk through those concourses, when you see the construction projects, when you see things going up, I'm proud to say because of her, because she loved me so much, and because God loves me and knew what my purpose was. I do the closeout financial construction audits for all those projects that you see going on. I've had the opportunity to do that and be a part of that, to see Atlanta transform.
This black woman is in time. She's something new. We love it. And that's the purpose of this show. We cannot keep all that God gives us to ourselves. And we're not
Right.
supposed to. We're blessed to be a blessing to others. When we hold everything to ourselves, we can't raise up our children and we
That's
can't
right.
raise up a community. And that's what we're doing here. We're raising up a community. It's going to take all of us. Our mission is to bring awareness, to increase the awareness of resources in the community, and we're providing those resources. So this room, ladies and gentlemen, should be full every last Tuesday of the month. We are deliberate to look at what the community lacks, and we're bringing that to the forefront. So we appreciate you, Regina. You keep doing what you're doing. We're gonna keep doing what we do here as long as we keep having great partners like you.
Absolutely, thank you.
Yes, it is wonderful. Let's give Regina a round of applause. Thank you. And for those of you who are here and those of you who are watching, I would also like to take this opportunity to share with you some of the very, very exciting things we are working on here at Junction 2800, which is the home of the Mary Parker Foundation. Please, if you get any emails, any phone calls, or any text messages from us, please respond accordingly, because the feedback we get from you enable us to make more improvements with the programs that we're launching here at the Campbellton Road corridor. We are in the process of building an Empower You campus, but this summer we are going to launch the Empower You Academy for our children, serving children this summer, camps from ages 12 to 18. And if my team will allow me, we're also going to have one for our babies as well. So please stay tuned, follow us, respond, and come out to the events that we're having. Also, on May the 7th, we're bringing a whole team to talk to us seniors. I now am one of them. Talk to us about the benefits that we are not aware of that's within the Medicare programs, the Advantage Plus programs. We're bringing attorneys, we're bringing insurance companies, we're bringing representatives from Medicare, and we're bringing doctors as well. So you don't want to miss this one. If you're not a senior, take it from me, as my mother said, keep living, baby. You'll be one of us too. I want to thank each of you for being here today. Keep up, keep watch, and stay tuned, because there's more to come. God bless you all.